The average loan, $32,000. But listen, you know this. You could pay $60,000 for a GM pickup truck today. Everybody's either leasing or borrowing the money. How much do rates matter to car sales?
Well, certainly rates matter because 90% of people do not pay cash for their car. It doesn't matter whether it's a new or a used car. The average car for a consumer costs about a third of their net worth. And we're all spending about 15%, 15% of our gross income on everything related to owning and driving a car. But lower rates definitely historically help the new car business because if you keep in mind the cost of a new car is nearly twice the average cost of a used car. So when you have lower rates and times are good, people tend to flock to new cars, and that helps the industry. But new car prices have been steadily increasing. The consumer price index on new cars is going up, whereas the consumer price index for used cars has been going down by contrast. And in as much as the interest rate is going to affect what people pay for their car and their monthly car payment, nearly half of what we all pay on our car payment goes to paying for the money, not just the car itself.
What?
So
wait, nearly half goes to interest rates. In other words, half the quote value of your car is simply interest paid to a bank?
That's correct. You've got about 150 million global transactions for used cars on planet Earth. You've got another 80 million new cars that are being produced on planet Earth. The average interest rate paid for a car is about 10%. So that means that half of what we're all paying for our cars is going to the money used to buy the car itself.
Let's flip this then. If rates rise for some reason, obviously they've been going down, will probably go down if the Fed cuts rate. But if we see a spike in rates, given all the numbers, the big, scary numbers you just laid out for us, Scott, that has got to terrify the car makers.
Well, what tends to happen when rates go up is leasing becomes a bigger part of the strategy because leasing is a really effective way to get drivers behind the wheel of a more expensive car for less money because you're not financing the full selling price of the car. You're just financing the depreciation on the car, and therefore you can get more car for less money. Today, 84% of all premium and luxury cars are leased. That's nearly double what it was in 2009. So when we went through a real recession in 2009 and interest rates were very high, consumer credit slowed on the new car side, as a way of reinvigorating the new car market, OEMs and captive financing companies tended to lean very heavily on leasing, which is what put more cars on the road. But the result is that you tend to have a knock-on effect where used cars become a great value because the cap costs tend to be very low.
Yeah.
And we're going through a pretty radical shift right now in the industry where we've been at peak production for the last 3 to 5 years. So there is a glut of used cars coming back onto the market, nearly 6 million lease returns in the U.S. over the next 12 to 18 months. And that's really good news for consumers who are looking to save money on their car payment because the glut of late model used cars in supply on the used car side is going to definitely outweigh an interest rate plateau or
so
decline.
if you're thinking, practical advice, if you're thinking about a car now, maybe wait a little bit. You could probably get a really nice 2 or 3 year car with 30,000 miles on it, not on the cheap, but cheaper.
Well, used car prices are going to continue to fall just based on the supply-demand equation. If you look at, car sales, both new and used car sales over the last 100 years, they've remained constant and almost perfectly correlated to population. The cyclicality of the car business tends to be around economic externalities like interest rates. And when interest rates are lower, people tend to shift to new cars because it's cheaper to borrow the money. And most people do not pay cash for their cars, they borrow.